Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. PwC have reported that 1/3 of Australia is already in recession. Is the rest yet to follow? Well, that's exactly the question I asked Andrew Bragg, Head of Policy at the Financial Services Council, when I caught up with him today. Andrew Bragg, thank you so much for taking the time to chat with us. Always a pleasure to catch up with you. Thank you.
Good morning.
Okay, so the PwC has warned that 1/3 of Australia is already in recession. Is the rest yet to follow?
Well, we've had 25 years of economic growth in Australia, so we've had a pretty good run. We would say that as the economy still continues to grow this year at 2.5%, the future looks reasonably good, especially as we look at some of the sectors of the economy which we haven't really focused on in the past, such as services. So there is an enormous potential there to increase our exports in services, and financial services being one of the keys to our future economic growth.
But still perhaps not really the outlook the Australian government would have hoped for perhaps in that post-budget period? Or is it that, sort of only 6 weeks on, it may still be a little bit too early to tell the success of the budgetary measures?
Well, it's not like it once was. I mean, the government doesn't sit there with a bunch of levers. It can't just pull and pull the chain and things will happen. The reality is that the government controls its budget, the government controls its expenditure, the government doesn't run the economy. So what is important is that the government gets a good handle on its budget position over the longer term. And we know the intergenerational report showed that our expenditure trajectory is frankly unsustainable with our ageing population. So the government has a lot of work to do. We can focus on the short term, but really it's the long term which is the key.
The FSC commended the government, in fact, for the removal of superannuation from that budget cycle almost. However, there has been some criticism elsewhere that the government's plans for pension asset tests could in fact hit those middle income earners the hardest. Does it really have to be sort of an either or situation between superannuation and pension, or is there a way to support both really?
Well, there's two different issues there. The first one goes to superannuation, and the reason we have superannuation is because we have an ageing society, and so we need people to save more money privately, because over the longer term, the pension just won't be able to carry the can for all the retirees, because our ratio of people working to those retired is going to turn upside down. So we won't have the tax base to provide the sort of generosity we find today. So that's why we have private sector superannuation funds. Now at 9.5%, which is the current compulsory rate, it's just not enough to get the average person to a self-funded retirement. So that's a big problem. So we need to look at that over the longer term, and that is precisely why we say don't look at this on a year-to-year, budget-to-budget basis. Please look at it over the longer term. In terms of the pension, I'd make the same point that it's not sustainable over the longer term to be providing people with a part or a full pension, given the trajectory of the budget and the ageing population. So the tightening of the means test for the pension is very welcome, because we're not in a position to give millionaires part pensions anymore. That may have been possible 10 years ago, but it's just not going to be possible going forward. So tightening the means test is a welcome reform.
So if we are moving forward then, looking ahead, what could the next test be then for the Australian economy, or could, as you've already suggested, it be a little bit brighter?
Well, we're trading on past glories, and we carried a lot of reform in the 80s and 90s, especially on tax reform and macroeconomic. So at the moment we have a tax system which is uncompetitive in our region. So for example, we have the second highest reliance in the OECD on personal and company taxation. We also have the lowest and narrowest consumption tax base. So what we're starting to see is our trading partners, our competitors, New Zealand and Japan, in our own time zone, are starting to shift their reliance away from company and personal taxation. That's making them a lot more competitive in our region, and more like Singapore and Hong Kong, which have company tax rates more like 20% than 30%, which is where we are. So we have to get on that reform boat. There is a tax discussion paper process the government is looking at. It's really important that as we look to the next election, that both of the major parties take that process very seriously and do look at structural tax reform, because we will need that to sustain our high living standards.
Andrew, thank you so much for your time today. Much appreciate it.
Thank you.
That's all we've got time for right now, but do stay tuned to Dukascopy TV, as the TV team will be bringing you plenty more exclusive interviews and FX analysis. For now though, it's goodbye from me.